Hello and welcome back to the Market Mosaic, where every week we break down macroeconomic data, stock market technicals, and take a look at things like market internals, including breadth and sentiment, to try to come up with a view of where the stock market could be heading over the near term. And so let's get ready for the week ahead. Looking back, investors were dealt some bad news on the inflation front, but across both consumer and producer measures. We had the CPI. That came out first last week for July, increased by 2.7% compared to last year. That didn't look too bad. That was in line with estimates that matched June's pace, but it was the core figure that surprised to the upside. The core figure that excludes food and energy prices, that rose by 3.1%. That was slightly ahead of estimates, but it also marks the second consecutive month where the core measure is seeing a faster rate of change. It's the rate of change that really matters to stock prices here. But it didn't stop there. The PPI, the producer price index, was running even hotter. So the PPI gained 3.3% in July compared to last year. Core figure increased 3.7%. If you look at the month-to-month change, it was up 0.9%, and that was well ahead of estimates for just an increase of 0.2%. And it was the biggest gain, the biggest monthly gain in the PPI since inflation was really jumping higher in early 2022. Here's why you need to pay attention to this. So the PPI, it measures the average change over time in the prices that's being received by domestic producers for their input. And so what that means is that the PPI can often lead changes in what consumers are paying. So the PPI tends to lead what you see in the CPI. And so that's why you should pay close attention to what I'm going to call crossovers. When you see the annual rate of change in PPI crossing over CPI, that could be a major inflection point, hinting at a major inflection point for inflation. And so the CPI is the green line, PPI is the blue line. I took this chart back 10 years, but if we look more recently, you can see, again, the blue line, this crossover below, well before the pandemic ever hit, warning of a deflationary episode there. But then take a look at what happened at the start of 2021. PPI jumping way over CPI, hinting at higher inflation to come. Not a lot of concern with inflation back here, but PPI was sending a big warning. PPI peaked a couple months ahead of CPI, dropped back below, so we've had that disinflation trend since then, but look at what's happening now. The actual PPI crossover happened back in 2024. It's held mostly above CPI, but you can see it's accelerating here once again. So that's something I'd really pay attention to. It's just the latest warning. We've had a lot of warnings that accelerating inflation could mark the second half of the year. This is just another warning. But that's not the only thing that could complicate matters, especially for the Federal Reserve. And that is because, the Fed, it looks like they could be facing, sort of this scenario of stagflation, rising inflation with a weak labor market. We had the weak July payrolls report, and that payrolls report also saw downward revisions to prior 2 months. But if you look elsewhere, and we're going to look at this in just a minute, if you look elsewhere, estimates for economic growth are holding up quite well. You can just look at last week's retail sales report. Following that data point, the Atlanta Fed's estimate for third quarter GDP growth is holding up at 2.5% annualized. And so you have evidence of a strong economy along with accelerating inflation. This could really put the expectations for interest rate cuts on the back burner. So there's all this hope, this hype building that the Fed's going to come out and really get aggressive in cutting rates, or at least that's the hope for administration officials in Washington. But this strong economy, rising inflation environment could complicate that. So let's look at some let's look at some things on the inflation front and look at some evidence that tariffs are starting to really impact what we're seeing with the inflation picture. But we're going to look at things that say, hey, the economy's holding up really well, and why that outlook is continuing to support the rally that we're seeing in stock prices right here. All right, so let's first start on the tariff front and how it's impacting inflation. The tariff rate currently stands at 18.6%, all right? That is the highest level since 1933. And one concern that's been coming across from rising tariffs and the trade war is how is that going to impact inflation, and as if companies paying higher costs, if they're going to start to pass that through to consumers in the form of higher prices. And there is some evidence, there's growing evidence that is happening. So when you look into the guts of the PPI report, it is showing us some evidence that businesses are increasing their prices. And so that's what this chart on here is showing. This chart is showing something called the trade services component of the PPI report. And it measures the margins being received by wholesalers and retailers. And with this recent jump, you can see this monthly jump up to 2% on here, highest level that we've seen in a couple years. That suggests that producers are rising their prices above cost. So again, that could be factoring in those added tariffs and attempting to pass that through to consumers in the form of higher inflation. So with these inflation reports now behind us, behind us, investor attention is going to be squarely fixated on Federal Reserve Chair Jerome Powell and his speech at Jackson Hole. Jackson Hole, that venue, has seen some pretty pivotal moments in sort of if the Fed's going to make changes to policy or to broadcast, upcoming changes, things that are in terms of how the Fed's views are evolving. And so this could definitely be no different. So we're going to get a look and maybe see how the Fed is viewing the balance of risks between what we've seen with the labor market and some of the weakening data there. But now we have this rising inflation as well. But here's the other thing, we can pay attention to past speeches that Powell has given to give us some insights into the things that central bank officials are watching to make these policy decisions. And I would go back to 2022 to when Powell was talking about some of the things they watch as it informs the Fed as to how core inflation could evolve. And so breaking down the really important components of core inflation, you have core goods, you have shelter costs, and you have core services excluding those shelter costs. And that's what we call the super core inflation. Have you seen that term thrown around a little bit? Now, the annual change for each one of those three core components is plotted here in this chart below. So you have core goods, you have the services less rents. This is that super core measure. And then you have shelter as well. And here's what I would really pay attention to. Look at these inflection points. You can kind of see this going back as well. Core goods tends to move first, then super core, then shelter. And look at what's happening recently. Core goods has been inflecting higher since the start of 2024. You're now seeing super core pick up a little bit more, and we'll see if shelter eventually follows suit. That again, these trends, especially the recent increase in core goods and super core, that could be another big warning on the risks of inflation ahead. And we'll see if Powell this week, tips any of these measures in terms of how they might evolve their outlook for cutting rates or the thresholds that need to be met for cutting interest rates. All right, now, despite the higher than expected core consumer and producer inflation reports for July, there really hasn't been a lot of movement on the expectations for rate cuts, meaning after seeing higher inflation, you would think maybe investors would reprice the outlook for rate cuts and think that there's a smaller chance of that happening. But odds for a quarter-point rate cut at the next meeting in September still stands at 92%. So the market views a quarter-point rate cut at the upcoming September meeting is pretty much a lock. And I've also talked about how the 2-year Treasury yield, that tends to lead changes in the Fed funds rate, but it is hovering near the recent levels that we've been at. And now this is where things get really interesting. If you look at the historical track record of what it takes to get the Fed to move, and that's what I want to talk about in this chart. Unless there are clear signs of trouble for the economy, investors may get a surprise right here. The Fed may decide to hold rates higher for longer than many are expecting. So take a look at this chart. It shows the annual change in core CPI, so in the core consumer price index, that's the blue line. This green line on here is the effective Fed funds rate. And here's what I want to call out attention to. I took this chart back to 1990. These shaded areas show recessions. When you have the Fed holding monetary policy and the Fed funds rate in restrictive territory, so when you see Fed funds well above the rate of inflation, it has taken a recession to get a meaningful reduction in the Fed funds rate, to bring Fed funds back below where CPI is at. So look back here in 1990, you get a recession, a sharp drop in the Fed funds rate, restrictive throughout the 90s until we get the recession in the early 2000s. That led the Fed to slash rates again below core inflation. Here we are heading to '08. Again, you need the recession before we see a meaningful reduction in the Fed funds rate. Same thing heading into the pandemic. You got a Fed funds effective rate for just a brief period above core inflation. The pandemic hit, see rates drop. Now we're in restrictive territory again, and we've had this cut, a handful of cuts last year. But it may take something some more serious risks on the economic front to really see Fed funds move back toward or even get below where core CPI is. And that, again, is just based on the historical precedent of what it takes to see the Fed really move monetary policy. All right, so concerns over the strength of the labor market, that's growing recently following that, again, that July payrolls report, and we had the downward revisions to the prior 2 months, but you're not really seeing that weakness show up in broader measures of economic activity. And the other thing that's has been clouding recent economic data points has been the trade war and tariffs. Well, that noise is starting to go away. Some of the pre-buy and consumer spending estimates for current quarter GDP growth are holding up. I mentioned earlier, we have the Atlanta Fed's GDP Now model that's pretty widely followed. It's showing 2.5% annualized growth. Look, this isn't, but it's certainly not a recessionary reading coming off of these estimates. And it's being driven by a moderate growth in consumer spending. So that's what you want to see. This is not as widely followed. The New York Fed has a GDP Nowcast model as well, and it's echoing something similar. So it's standing at 2.1% annualized for the third quarter. So this shows the evolution of that estimate since May 30th. And right now, that get fed into this estimate are evolving. You have this figure. The other week, I mentioned S&P Global's PMI. It was also consistent with 2.5% growth. So that weight of the evidence suggests that the economy narrow breadth, but that's not really for the S&P 500 what upward earnings revisions looks like as a percent of all the revisions looking ahead over the next 12 months. And you can see this figure surging from the April lows. It is at a level, it's at the highest level since 2021. So we've had a massive tick up in positive earnings revision. That's reflective of the earnings outlook, and that can keep the rally going here. Stock, if you look at the quarterly year-over-year sales and earnings growth are both surging higher. This company is leveraged to the AI theme via data centers operating on clean energy as well. And I zoomed in on the chart here. If you take this chart back a little ways, you'll see that this 1550 area right in here, this was a really key level tested a couple times, and we've come over that recently. The stock, this is very common. When you have a breakout over an important resistance level, FireEN can get over this $20 level on a rise in volume. If that volume is sufficiently above average, you'll get a big purple bar down here. This looks at the standard deviation of volume. You want to see a big purple bar. You want to see that at new highs. And we've had this bullish momentum reset above the zero line on the MACD. So all these things really coming together that could help see IREN move above this $20 level and complete the next phase of the breakout. All right, that is all for this week.